Kathy Bostjancic is chief economist at Nationwide Mutual. Kathy, it's great to have you here. Welcome.
Thank you, Kelly. Happy to be with you.
Am I right in that what this morning gives you a little bit of a change in heart?
Well, I think it's really the totality of the data, sort of what Steve was outlining. There are still headwinds, so we're not ready to abandon the call on a recession. At the same time, you have to respect that the incoming data continue to point to resilience and stronger activity. We saw growth accelerate in the second quarter, and now as we head into, we're in Q3, but in the early portions, it looks like we have good momentum. So you're looking at GDP growth maybe coming in around 2% again. That's far from, a downturn or recessionary signals. But keep in mind that the banks are tightening lending standards. We saw that yesterday.
Yep.
All of the measures, right, whether it's the credit availability or the cost of credit or even the demand for credit, all of those measures are at recessionary levels.
Yeah.
So the question becomes, what's the resolution going forward, right? We have the manufacturing sector still in recession, but the service side is doing well. Housing, looked like it was, it was in recession, now coming up a little bit. So how does it resolve in the next couple of quarters? Lots of uncertainty, but, our view is there's still a lot of tightening. And if the economy doesn't slow enough, the Federal Reserve will just simply do more to slow it down.
Let's keep that ISM index that we were just showing that kind of shows that one works as well. Kathy, and Steve and I have talked a lot about this. And so are you in the kind of so bad it's good camp? In other words, the reaction to ISM this morning, there's the chart. The sort of investing public seems to look at that and go, you know what? It's not going to get a whole lot worse. And so if you invest around the turning point when it starts to get better and the cyclicals can do better in the industrial. So in other words, is the ISM going to start to get better and it can just trough and then come back again without the recession ever happening? And it's just a manufacturing specific issue.
Well, you essentially outlined the soft landing camp's view of things that, yes, we're troughing, we're hitting the bottom, whether it's housing or manufacturing. And then going forward, those sectors are actually going to rise to meet and be closer to what's happening in the service side of the economy, as vice versa. I'm more worried that as we go forward, even if the Fed doesn't increase the funds rate further, just the fact that we're going to see a gradual slowing in inflation, the real Fed funds rate gets tighter. And this is a new sort of paradigm or test for the Fed, or a method of operation. Like they usually are cutting rates, at some point soon after. But if they keep it elevated and in real terms, it still remains quite restrictive. I mean, that's a different backdrop for the economy.
Steve?
So, Kelly, do you remember when we were in Washington, I drew that funny chart for you that showed
I think about it all the time.
Lines at different times? I'm gonna call that ASD, asynchronous sectoral declines, okay? And I think what has to happen for the U.S. to be in recession, I'm going to try some air charts here. I wish I brought it along, but like trough. The troughs have to stack up in negative in order to get the full U.S. economy to be negative. And that's not what's happening. Again, if you could call out that ISM chart, I want to give you a slightly different read. You can look at that chart and you can say, wait a second, has manufacturing maybe stabilized here? Has it reached a bottom as you see it kind of ticking along that 46 kind of range? Remember, 44, I think, on that measure is a recession.
Right.
46 is contraction in the manufacturing sector, but not in the overall U.S. economy. So it may be that things like manufacturing and housing, and this is kind of rose-colored glasses, the soft landing is happening kind of thinking, but if you have manufacturing kind of bottoming, not getting worse,
right.
Housing looks like it's bottoming, not getting worse, those things are not going to be part of the negatives you need to stack up to get a contraction in the U.S. economy if you do ASD.
No, I think it's very well said. So, Kathy, this kind of idea of these rolling downturns, so housing's now starting to come back, and what if manufacturing comes back? And then, do you think that can happen for the business cycle, that it's so asynchronous that it never actually, it starts to expand again before it ever outright declined?
It could. I mean, certainly, we don't assign zero probability of the soft landing outcome, and I would say the odds have risen for that. But that said, when you see the leading indicators like the Senior Loans Officer Survey, banks are tightening credit even more. I mean, eventually that's going to have an impact. And when I, match that up against like high yield or investment grade corporate bond spreads, something has to give. They usually move in tandem, and now you've got this really narrow, corporate bond spreads, and yet banks are tightening credit. So how this resolves, it's very similar to the manufacturing or housing versus service side of the economy. My sense is, we can't rule out recession at this point. It may be later. But there's still a lot of leading indicators and tightening in the pipeline that we could still get a recession.
All right, we'll ask my next guests about that very question. Kathy and Steve, thank you both. We appreciate it. Kathy Bostjancic or Steve Leisman.